Hey everyone, welcome to Sum Zero. Today we're talking to Adam Wilk of Greystone Capital. Greystone's a value-oriented, long-only RIA based out of Pennsylvania. Adam's been a Sum Zero member for a long time, and he's got quite a track record on the platform. I think, Adam, you're one of the best or most notable kind of small cap focused managers on Sum Zero. And today we wanted to hear a little bit more on you and also on a micro cap, Sylogist, which I think trades out of Toronto. So just really quickly, as just for some background on yourself, I know you've got a background in sports, so maybe you can just quickly give us a picture of how you got into value investing, and then we can dive into Sylogist.
Sure. Yeah. Thank you for the nice introduction and for the invite today. Really appreciate it. Yeah, so I started my career working in sports with a number of different NBA teams. I was in a basketball operations, scouting, analytics roles. And to give you the shortcut, I had no idea how helpful that would be today. I took a hard career pivot over a decade ago when I was introduced to value investing and immediately took to it. It was incredibly interesting and made perfect sense to me. It appealed to my contrarian nature, I think, and just kind of sparked the enthusiasm to build something on my own after learning about some of the greats in the industry. And I took a number of steps to pursue Greystone. I started by sharing research and write-ups online, places like Sum Zero. I was managing friends and family money. And again, I spent a lot of time just studying some of the great investors and read all the books, and that led me to Buffett and Greenblatt and Peter Lynch and all those guys. And I formed Greystone on the back of that information and kind of using a handcrafted playbook. And the idea was really to set up or to build kind of a differentiated firm that's structurally different from larger funds or asset managers, where I'm not really trying to reinvent the wheel, but just doing things that people can or won't do. And as you mentioned, the firm is a long-only equity-focused strategy in small caps and micro caps. And the basic idea behind what I'm doing is to try to, again, sort of create a world where I could spend most of my time doing what I consider the highest value add activities in investing, such as research and portfolio management. And I've really made it a point since inception to focus on those things. And yeah, I've been attempting to kind of scale ever since then. And again, really just focusing on what I view to be the most inefficient areas of the market in small and micro caps. And we're trying to find.
And when you say structurally different from a lot of other funds, I'm assuming you're referring to the fee structure or holding period or something along those lines. Like what is unique about the way you've structured the fund itself?
Sure. So I have a sort of tagline or thing that I'd say that goes smaller is better in investment management. And the idea with Greystone is to remain that way, which I think provides a number of advantages for somebody like myself that, again, as you build an investment firm or a hedge fund and you grow and scale, your opportunity set dwindles or at least becomes very different from somebody like myself. And so when I say structurally different, right now I'm a one-man investment shop. And so I'm the lead analyst and PM. And so there's no bureaucratic process behind decision-making. I can kind of move quickly and I'm free to invest anywhere. I run a very concentrated portfolio, which kind of bucks the conventional wisdom around diversification and is difficult sometimes for larger funds to do. We own between 10 and 15 stocks, concentrated in the best ideas. So again, no diversification. There's a small company focus, which again, below a certain market cap threshold, larger funds have a very difficult time accumulating positions in these types of businesses. So they can be kind of underfollowed or parsed over a little bit better by somebody like myself, where there just aren't as many eyes on some of these opportunities. And then to your point, I try to adopt long holding periods. So everybody, I think, knows the stat behind the average holding period for a stock on Wall Street is somewhere around 6 months. That's 2 quarters. I usually don't invest in anything where I can't try to take like a 3 to 5 year view. And so, you could call that time arbitrage, but it's really just letting sort of the business play out and let compounding work to our advantage. And then most importantly, I'm aligned with my investors. And so there are a number of problems in our industry right now, one of which I think is alignment between investors, portfolio managers, and their clients or LPs. 90% of my net worth and my family's net worth is invested in the firm. And so I eat my own cooking and I'm invested alongside clients, and we're very aligned in terms of what we're trying to kind of accomplish over the next however long I'm doing this, which is hopefully a few decades.
Great. So let's use Sylogist as an interesting kind of case study on your investing philosophy. I mean, how did you screen for it? I'm curious how you first heard about it, and then what made it attractive to you to invest in ultimately.
Sure. So I think Sylogist fits squarely within my sort of idea generation process. Typically, there are four sources of ideas for me. I have a watch list and study list of businesses that I follow over time. Just having done this for a long enough period of time, you get familiar with businesses and industries. And so that list has grown over the years, and I'm constantly kind of cycling through those businesses and following them on a quarterly basis. The other source is speaking to investors and attending conferences and forums and just exchanging notes with people within my network. The other is adjacent ideas, which is studying businesses and then coming across a company within that work where you're like, oh, this is interesting and I want to learn more about this. And then there's, just kind of continuously working to build a wide base of knowledge and pattern recognition and reading constantly. And Scylla just kind of hit on all those buckets, but I found it by reading an investment manager's letter where he mentioned he was providing some commentary around small caps, and he mentioned the fund is Toronto based, where he's the portfolio manager. And so I just jotted it down, and the way he described it kind of checked off a few of my boxes. And as I learned more, I just became more intrigued, and it's now inside the portfolio, having checked a lot of boxes for me.
And how big of a percentage of the portfolio is this particular stock at this point?
Yeah, so I would call it a mid-sized position. So typically for core positions or top 5 positions for us, they make up maybe 65, 70% of the portfolio. So at cost, they can be between 10, 12, 15%, between
Wow.
10 and 15%. This one is not quite as large yet, but I'm also looking forward to adding to it. So I think over time, as the company executes and as the thesis continues to be proven out, it will increase in size. And I have no issue with averaging up, but right now I would call it a mid-sized position.
Got it. So tell us about the business. What do they do? And we can get into valuation and some of the other elements later, but just if you can just describe the business first, that'd be helpful.
Sure, yeah. So they're a public sector software as a service business, so a SaaS business, and they they provide mission critical solutions to over 2,000 customers worldwide, and they operate in 3 verticals: nonprofit and non-governmental organizations. They have a government vertical and then an education vertical. Nearly 70% of their revenue is recurring between cloud subscriptions and maintenance and support. And then they have professional services revenue that fills in the gaps. The prior version of this business existed as a crappy reseller of software. And then in the early 2000s, they had a sort of little strategy shift where they pivoted to wanting to provide public market software via M&A. So they started buying up some smaller businesses. That's part of why the opportunity exists today, because there's been a significant strategy shift that took place in 2020. They ran a strategic review, tried to put the business up for sale. The board came out of that determining that the best course of action was to run the business for shareholder value for the first time in its history. Imagine that. And so that's what kind of created the opportunity today, where there was a management change, a strategy shift, a dividend cut, which I can get into the details of, and that kind of orphaned the stock and left it to where it trades today. But just getting back to the business, since that time period, they've transformed the company from kind of a no growth, high dividend paying on-premise type of business to the current version, which is their go-to-market offering consists of cloud-based software products. I would say to provide kind of like an example, within their verticals of government, education, and nonprofit, they have products like ERP, so like Workday, enterprise resource planning. They have CRM products like Salesforce, customer relationship management, and then they have a number of nonprofit fund management software, education administration, and payments products. All of these, they operate in a niche where they serve, again, public organizations. They stay away from enterprise, and they also are in an area where larger businesses like Workday, Salesforce, et cetera, SAP, they aren't really well adapted to offer the customized solutions that Sylogist can. And their products carry really high value propositions among their customer base. They have very sticky relationships, and they serve a really critical need. a good example of that is the past decade plus, the business was really mismanaged. They didn't treat customers well. They underinvested in their products, and they barely lost any customers. Which is, it's a data point to show that once you're one of these products is tied into your organization, it's there are a number of switching costs, and it's very difficult to kind of displace them over time, even if it's a function of price. And so one example of their, I guess, product set would be a nonprofit that requires more advanced donor fund accounting and donor management software that also integrates with the rest of their applications. And so they could use one of Sylogist's, let's say, CRM or ERP products to address those needs, where typically you're competing at the Sylogist is competing with like QuickBooks or even like a manual Excel worksheet, where the processes are oftentimes very manual, and they're able to obviously make things a lot more efficient.
But you're saying they're not competing with Salesforce, and you mentioned Workday, or I guess I don't know if Oracle's in this business, but kind of some of the larger, more enterprise-focused software companies. Like, it almost sounds like a quasi-custom or semi-custom approach to business software, like administrative software, accounting. You mentioned as being kind of one of the verticals, or like CRM. I mean, I guess instead of buying Salesforce or Outreach or some of the other products out there, this is like they would give you a somewhat custom solution. Is that the general idea?
Yeah, it is. And they're just in a smaller area of the market, sort of that middle market. And again, public market organizations where there's a little bit more need for niche products and customization, where larger businesses like SAP, Salesforce, et cetera, just haven't been able, they're not interested because of the contract values, but they also haven't been able to tailor their products to fit these organizations' needs. A lot of Sylogist products are built on Microsoft Dynamics, like 365 Dynamics. And so they can use that platform as kind of a reputation thing going into some of their sales meetings, but they also can customize basically anything an organization needs on the back of that. So they basically it's not every product, but they benefit from that relationship as well. And it's allowed them to kind of penetrate this specific niche of organizations over time.
And you mentioned customer retention. That's been pretty high. Have you quantified that?
Yeah, so the company, I think it's coming. They don't disclose it in terms of a specific number just yet, but my channel checks and everything that I've uncovered right now indicates that it's close to 100%. I think moving forward, they'll start to disclose customer and net revenue retention numbers, but even like during the period where the business wasn't really being managed very well, it was somewhere in the 97, 98% range. So it's very high. And again, once their software products are sold into these organizations and integrated into their workflows, they become very sticky over time. And that's part of the strategy moving forward, but it's one of the, I guess, areas that points to a high value prop that they deliver.
What are total consolidated revenues, and what's the growth rate that you're kind of assuming going forward for that revenue?
Yeah, sure. So on a Canadian dollar basis, they finished 2022 with just over 56 million in revenues. Right now, again, there are a lot of moving pieces, but the go forward business strategy is to transition customers from on-premise to their cloud-based offering, and also to attack new white space by growing bookings and their customer base, so that they can land and expand their customers. And over time, once customers are on the platform, they can sort of upsell and cross-sell different products and services to them, which is an effort that's been working very well lately. And then they also use channel partners to accelerate their sales efforts in a more cost-effective way. They've really spent the last 2+ years beefing up their sales and marketing department. It went from 3 people when the current CEO joined the business in 2020 to now it's around 16 or 17. The sales cycles in these industries are long, in government software and public software, typically between like 9 and 18 months, depending. 18 is probably on the high end. But those efforts are starting to pay off as well. And the company has been growing very strongly at a mid-teens rate organically over the last couple quarters. management estimates that's really the go forward run rates. In terms of consolidated revenues, I could see them growing between 10 and 15% over the next couple of years, organically. They're also complementing that with accretive M&A, which I can get into the specifics of, but they've done 3 deals since the current management team was hired that have really contributed on a revenue, EBITDA, and customer relationship basis. So moving forward, I think through 2026, 2027, I could imagine them growing between 10 and 15% organically. And then the M&A bent, I guess, isn't really factored into my valuation yet, but that's kind of another lever for value creation that they have. But management's target.
What do the margins look like for their core business?
Yeah, so consolidated margins are gross margins are around 60% right now. That's actually as a result of a lot of the investments they're making to grow their recurring software revenue. So professional services revenue has been accelerating over the last couple of years, and that's a sort of leading indicator to future growth in software subscription revenue. Professional services come with lower gross margins, so there's been a little bit of pressure there from like the historical margins of the business. That I think will get an uplift over time as channel partners kick in, as they can raise prices and as they cross-sell and upsell. So I think normalized margins over the next few years gross margins could be around 65%. They're also making pretty significant sales and marketing investments right now in terms of OpEx and product development. And so they historically, before the current management team was put in place, they were paying around a 9% dividend yield, which was about 12 million in annual cash flow. They cut the dividends. Fiscal year 22 was the last year the dividend was paid. So that freed up all of that cash to reinvest in things like sales and marketing and product development. Those efforts have been going very well so far, and they're starting to bear fruit in terms of the organic growth rates and the bookings growth and customer growth. As a result of those investments, EBITDA margins have been taken down intentionally from like 40 to 50%. They were significantly high prior to the current management team. And so now they're in the 25 to 30% range. Management thinks that they'll be around 25% for the next, I would say, 12 to 24 months. And then after that, I think as their sort of investments taper off, EBITDA margins have a significant chance of uplifting with all the factors that I mentioned, along with the fact that the market in which Sylogist operates is very collegial. And so it sounds kind of silly to say in 2023, but it's true. They operate, they gain a lot of customers through word of mouth. And as they do a good job in terms of customer service, and they continue to sort of build out their product base, they'll actually get a lot of referrals, and they'll be able to enter into a lot of RFPs that way. And management has mentioned this a number of times as that kind of happening, especially in like their ERP segment, or excuse me, with their ERP product. And so over time, I think normalized gross margins will come in around 65%, and their EBITDA margins should stay around 30. They're still targeting rule of 40 posture. So between their organic revenue growth rates of 15% and 25%, EBITDA margins, they don't give guidance, but they basically forecasted that rule of 40 will be in place moving forward.
And what does it trade at on a PE basis right now?
I don't know what their price to earnings ratio is off the top of my head, and it's a bit misleading just because they amortize software intangibles, and they do some M&A, and so some of that goodwill gets amortized as well. So in terms of cash flow, they trade at about 9 times EBITDA right now and growing. Free cash flow conversion has been around 70-75% historically, and so it's somewhere around 13 times free cash flow as well. Again, over the next couple of years, that valuation gets even more attractive. And I think if they continue to execute, not even factoring in M&A, I think they can generate somewhere between, the enterprise value is around 150 million Canadian dollars. I think they can generate somewhere between 18 and 20 million in EBITDA over the next year or two. And at which point the evaluation becomes very attractive. And in terms of their public comp opportunity set and also relevant M&A transactions, they traded a very significant discount for a business with their sort of fundamentals, growth runway, really clean balance sheet, and again, like the resiliency and durability of these businesses. They're very attractive to private equity groups. And obviously, if you look at case studies like Blackbaud, which is one of their direct competitors, or Tyler Technologies, those businesses have a long history of both organic growth, M&A, because they're rolling up a fragmented industry, but also they've been public market beasts and have very long histories of strong compound annual returns. And I'm not comparing Sylogist to those two businesses, but in terms of the valuation disparity, I think it's unwarranted. In terms of the turns of EBITDA, I think, at which it trades at a discount. So there are
What
reasons
is
for that.
Blackbaud trade at?
Blackbaud is trading at around 13 or 14 times right now. They're a little bit of a special case because they kind of missed the shift to the cloud, and management has underinvested in the business for a really long time. They're actually losing market share. Their retention numbers are dipping. Their revenues and margins have come down in the last 5 years pretty significantly. But even with all that said, they're actually in the midst right now of evaluating a takeout offer. So one of their largest shareholders, a private equity group, put a bid together for the business, which was like I think a 25% premium to where the stock was trading. The valuation that they suggested is around 12 or 13 times EBITDA, which is very opportunistic because I know that they see the opportunity to return the company to organic growth, raise margins, probably raise pricing, develop their products. And then, obviously that valuation would look very insignificant over time. So it's not a, super fair case to look at just because, like I said, it's very opportunistic, but they're still 5 or 6 turns higher than Sylogist today.
So what do you think? What do you think investors are just not understanding about Sylogist? Like what is the, I guess, insight that you've kind of developed that you just don't think markets understand?
Yeah, so it's a great question. I think this kind of falls squarely in line with my process in terms of identifying these types of opportunities. In line with the strategy shift that I was talking about, the company cut their very hefty dividend. They communicated to the market that they would be taking margins down. And then they also said that they would be making a number of internal investments that were set to drive shareholder value. So right away, when you cut a large dividend, you have a number of yield-focused investors that are shareholders that flee. So they're gone, and that put pressure on the stock. And then you have them talking about taking margins down. And if you don't understand the business very well or what they're trying to do, because it's kind of a new story, then you have a number of investors who also flee because of that news. I'm not going to hold on to a business that's telling me their margins are going to be lower from here. And then you have the internal investments where there's a bit of a show me aspect to it, and you have to earn a return on those investments, which they are, and it's working now. But I think investors are kind of missing this fundamental inflection point that takes a little bit to dig out because the disclosures aren't great at this stage, and I think they're working on it. But in line with kind of the things that get me going a little bit in terms of new ideas, the company's a microcap, and typically microcaps come with kind of an embedded discount. It trades on the TSX in Canada. It trades over the counter in the US. Volume on the TSX is around 100,000 a day. So very small company for larger funds can't own this thing. The float is not very high. I think the top 3 or 4 shareholders own 30 or 40% of the business. In line with my comments previously, it has a bit of a checkered past, which is in the rearview mirror, but I think some of that still stings. And then there's management and IR, I think, are working on their communication as we speak, and they're attending investor conferences and kind of trying to tell the story. And so when you put all those factors together, I think this isn't a business that, and then you add in what happened in 2022 with small companies and software related businesses in terms of multiple compression, you get this situation where people just probably aren't very interested in studying this business right now. I'm on here hopefully attempting to change that, but I think
I was going to say we should get the CEO on a call as well. I think a lot of folks would want to hear directly from the CEO. Is the founder still involved with the business, or is that person out at this point?
Yeah, so it's kind of, I would love to get the CEO on here. I'm on it. That would be great. And I appreciate that. He's a very impressive guy. So the prior CEO retired, and right before he retired, they ran a strategic review, as I mentioned. They were just trying to sell the business. They got a number of offers that didn't really, I guess, fit their valuation criteria. So they, again, the board determined that the best course of action was to actually try to drive shareholder value from here. And they went to look for a new CEO who would be given a growth mandate. They found the current CEO's name is Bill Wood. They found him through that strategic review process because he has a 20-year career in software businesses. He's been involved with 2 private companies both of which he led to a sale, one to private equity, the other to Constellation Software, which is everybody's favorite Canadian software business. And he's running the same exact playbook with Sylogist that he did with those two. And so he's also he's very aligned with shareholders in terms of his compensation package. So typically, I like owner operators. I like people who own a lot of equity relative to their compensation. He's not quite there yet because he's kind of a new CEO, but he was granted a 500,000 options package, 250,000 of which vests when the stock price is at $10 Canadian. The other half vests when it's at $15 Canadian. For reference, the current share price is $6 Canadian. And so as they continue to execute, it wouldn't surprise me at all if they received a takeout offer, because today's business is completely different from the prior management's business. It's better revenues, it's more durable, it's more resilient, better customer relationships. There's a better path to creating value here. And so, yeah, I mean, I think
is that option payout, is that option package meaningful relative to his kind of existing net worth?
That's a good question. I'm working on gathering that information, but I've done the math on what he stands to make if things were to materialize that way, and it's on an absolute basis, it's very material. But I can't answer that at this stage.
Yeah. Got it. And in terms of catalysts, I mean, you've talked a bit about takeouts here. I mean, are there any PE funds that have been circling the business that you've heard of, or any current shareholders you think might step up if they happen to come from that background? I'm just curious or are there other catalysts that you have in mind that could be relevant here over the next couple of years?
Yeah, so it's a good question. The feedback that I've gotten, I spent a lot of time speaking with strategic advisors in the government software space and people who advise on M&A deals, et cetera. And even the firm that Sylogist hired to run the strategic review a few years ago, and taken with a grain of salt, speaking with them, obviously, but they're very bullish on the prospects for them to get taken out at some point. I don't really bake that into my investment thesis. But again, the characteristics of the business, the valuation and the balance sheet make it so this would be a very easy acquisition for a private equity group. They wouldn't even have to write an equity check, most likely. And they would, given the free cash flow yield, they would do very well in terms of getting their money back over time. And so there's been, from what I understand, there's a ton of interest just in the space in general. And there's been a lot of parties kind of circling. But I think people are, again, needing to see a little bit more. Well, maybe not now because they are executing, but maybe needing to see a little bit more just in terms of execution. And I also don't think the management team is interested in selling at this price. And so they're very, very focused, maniacally focused on just operating the business and driving as much value as possible. In terms of catalysts, I kind of think value is its own catalyst on some level. But
Yeah.
As I mentioned, with the increased disclosures, the company's starting the investor sort of a conference circuit now. They're attending one next week. I'm speaking to them afterwards, and which is a great sign. It's the first one they've attended in a long time. They're holding their first ever investor day in June in Toronto. So in about a month, where investors and shareholders can come and kind of learn more about the business and get face-to-face with management. They're going to start improving. They just hired a new CFO, which is a huge upgrade to the current CFO. And he's going to meet with investors and determine what disclosures everybody would like to see and what metrics are important to disclose for a software business. Not that they don't know, but just to kind of see how people would like that laid out. And so getting those fundamentals kind of disclosed and people realizing how attractive they are, I think will go a very long way. And so there are a number of kind of soft catalysts, I think, on the horizon. And then again, as the company continues to execute and a few more quarters go by and maybe people stop, I guess some of the fear dissipates in terms of the broad macro environment. I think the setup is very attractive here.
And from a sort of a target valuation standpoint, where are you currently? I mean, is $10 kind of your own personal target on the stock, or is it something higher than that?
Yeah, it's a good question. I think using conservative assumptions and looking a few years out, I don't think there's any reason why, if the company continues to execute, that they can't both generate more cash and also get a little bit of a multiple re-rating. I'm not saying they should trade in line, or I'll take a step back. So some of the businesses I mentioned before, like Tyler Technologies, Blackbaud, is not quite as high. Sage Group, Power School, et cetera. They're so resilient and durable, and they operate very well through all economic cycles, and their fundamentals are so good that they typically trade at, 16, 18, 20 times EBITDA. Not saying Sylogist could trade at those levels, but I think over time, a market multiple would not be unfair to imagine over the next year, 24 months, et cetera. If that were to take place and these internal investments continue to pay off, I think that, somewhere around a mid-teens multiple of 2024 EBITDA could get the share price up to, $10 Canadian, or excuse me, 12 or $13 Canadian, or about $10 US, which would be over 100% upside from here. That's not factoring in any M&A that they're going to do, and their pipeline is growing. They've made 3 very good acquisitions that are contributing nicely since 2020. And I think a few deals are on the horizon. I wouldn't be surprised to see more deals this year, next. And then they also have a 50 million share buyback program in place that they've been exercising, which, if executed in full at these prices, they'd be able to repurchase about 10% of the business, which would obviously increase free cash flow per share. So without factoring those into the valuation, I think it's still very attractive just on a pure fundamentals basis. If there's no multiple expansion that takes place, which would kind of be a very pessimistic scenario for me, I still think at this free cash flow yield, the IRR is and growth rate, the IRR is very attractive over the next couple of years. So that's kind of how I'm looking at it, if that makes sense.
How do you factor in macro headwinds in terms of just the rates environment? I mean, is what the Fed is doing part of your calculus at all in terms of how you're kind of discounting cash flows, and just thinking about what the valuation should be, what an appropriate multiple should be for this kind of name?
Yeah, it's a good question. I always struggle at the end of doing valuation work in terms of like where a company should actually trade. I spend a lot of time trying to figure out what these assets could be worth, and maybe my prior comments kind of reflect that a little bit. But look, I mean, again, with rates at 4 or 5%, even a, close to 10% free cash flow yield that's growing, 10 or 15% is still very attractive in this environment, especially for, again, businesses that have shown incredible resiliency through all economic cycles. I just think, and then the shift to cloud subscription revenue means that the business is more predictable and there's more visibility there. And so the market loves that stuff. And I think, again, over time, if they can continue to execute, there will be some recognition of that. Having said that, right now, the market is in sort of a holding period, I think, and there's a lot of uncertainty on the horizon. If you ask my opinion, I would say the Fed is committed to bringing inflation down. I think it is coming down. And I think, maybe we reach a soft landing or a less severe recession or something. But the way I look at it is, there's always a reason to not own stocks. And I don't think that will ever change during good or bad times. And the good news is my process isn't really focused on predicting what's going to happen in terms of the global economy or what the Fed will do next. I run a bottom-up strategy where I'm really focused on identifying investment opportunities that can do well, kind of regardless of the economic environment. This is a business-to-business company, so I like that angle too, because the consumer, could be hurting for at least in the near term. And so taking a long enough view, I think, regardless of what happens in terms of the macro environment, I think this could work out well. But I'm also, none of our investments and no part of my process relies on kind of like overly optimistic or rosy expectations, either for the economy or these businesses. I try to be very conservative, accurate, but conservative. I try to make it so that, looking a few years out, it would be difficult to imagine losing money owning something like this. And so
Sure.
I've never
So what would you say, what would you say are the, more company specific risks here, putting macro aside for a moment? Like, what would you say are the biggest risks to the thesis?
Yeah. So obviously a huge part of the thesis is predicated on the company being able to grow organically, to grow their revenues organically in terms of cloud subscription revenue. If that were to not happen, I think that would be good evidence that either their internal investments aren't working, or that there's been something happening on the competition side where the road ahead will be a little bit more difficult than imagined. So focusing on that KPI is very important. And along with that, things like customer growth and bookings, which I think they're going to start to disclose a little bit better, along with some of their relevant software metrics. If those things aren't trending in the right direction, it would probably give me a lot of pause in terms of what they can accomplish moving forward. Um, Management has taken margins down a decent amount, and I think they're pretty much fixed where they are right now. If they were to continue to do that, I think it would call into question not only what's happening at the business level, but also maybe their credibility in some way. So there's kind of an eye being kept on that as well. In terms of the M&A landscape, if they were to do some deals that weren't very accretive, or if they decided to overpay, I think that would be a big knock on kind of how the strategy will unfold moving forward. We haven't seen that to date, and also they've been very conservative about trying to acquire businesses now, and almost too conservative because they haven't done a deal in a long time, and they're kind of waiting for private market valuations to come down. So those would be some of the really big risks. But then again, in terms of valuation, there's not getting multiple expansion, which kind of aligns more with my hurdle rate than a business specific thing. But and then I guess there's kind of like
to kind of end on a more, I guess, positive note, though. I mean, what would you say is the most exciting upside scenario here for the stock?
Yeah, I mean, I'd imagine.
You were talking about wanting to buy some more, so I'm curious. Like, could this more than double? Like, could this be a triple or beyond? If so, what would get it there?
All right. So the dirty little secret with my valuation targets most of the time is that I typically undershoot what I think could really happen. But I kind of refrain from aligning myself with a sort of blue sky scenario. Having said that, typically what I look for are severe mispricings. And so when something is trading at $6 per share, of course, I think it could be worth 12 or 13 over a reasonable time frame. But I also think there's a possibility that the business could be worth over $20 a share. I think if the company continues to execute and their sales and marketing efforts start to pay off, and they execute accretive M&A, their their organic growth rates are going to accelerate very, very meaningfully, and there's going to be some margin uplift, and they have the opportunity to still buy back some shares. And if they kind of do all those things in tandem, or those KPIs start to inflect even more than they already are, because management is typically under promised and over delivered to this stage, I think that the multiple will re-rate significantly. And then as the stock goes up, obviously, like, liquidity improves, and so more investors can enter the picture, and those incremental buyers start to become a little more interested. And so, yeah, I mean, in a blue sky scenario, and then you get the macro piece where maybe the economy, we go into a recession, and maybe the economy starts to recover and people get a little more comfortable. Yeah, I mean, this business can trade, at 18, 20 times EBITDA, I think. I'm not sure that's what it's worth over time, but I think that's a scenario where that could happen. And in that case, yeah, the stock could more than double, in my opinion.
I think that's a great way to end it. And as I said earlier, it'd be great to follow up with the CEO himself. It sounds like he's got a pretty impressive background and has a lot of skin in the game as well, just like you do in the stock. So, Adam, thanks again for joining us, and we're looking forward to staying in touch.
Yeah, thank you so much for your questions and for the interview. I really appreciate it.
Thanks, Adam.